How do you protect your $1 million asset? That's what we're going to be talking about today. Let's get moving forward. Welcome to the Plan Ranger, where our goal is to provide you with informed insights and a reasonable approach to managing your personal finances. Now, today we are talking about quite possibly the sexiest topic of all. Disability income insurance, right? Okay, so maybe it's not the sexiest topic at all. In fact, one of the things we need to talk about is the idea that basically, while this channel is here to help you grow your assets and your net worth and things like that, as a channel based on personal finance, it's also important that you protect your assets too. We need to cover that. So protection is just as vital, perhaps more so than accumulation in a lot of ways. And so today we're going to be talking about one of the least sexy parts of that, insurance, and within the world of insurance, the even least sexiest part of that, which is disability insurance, disability income insurance here. So how much disability income insurance do you need? That is kind of the question we're going to get at. At the top of the video, I said, your $1 million asset and how to protect it. And that wasn't just clickbait. It's actually very, very real. And we're going to get to how we kind of reach those figures. But first, let's do kind of a quick review about how insurance works. So every day you have risks that you face. You have the risk you could fall down the stairs, have a heart attack, have a stroke, get in a car accident, this or the other. Now in the age of COVID, hey, there's always COVID out there. So we always have all these risks bouncing around us. And one of the big ones, perhaps one of the primary ones that catches younger people, everyone who's young always thinks, oh, it's going to be a car accident. It's going to be this or that. It'll be a stroke. The thing that would really cause problems would be a stroke for you. I've actually seen this a few times in my career, more than I'd like to. And it's one of those things that you really need to be cognizant of because there's not a lot you can do to prevent it or detect it beforehand. So that's kind of the scary part here. So you have risks that you face every single day, right? Some of those risks you can transfer and other risks you can't. The risk that you can transfer in this example, let's say taking a stroke. You can't transfer the risk to somebody that you have a stroke, but you can transfer the risk of the financial impact of you no longer being able to work because you had a stroke. And that's kind of what we're talking about here. When we talk about insurance, we're talking about your ability to take a risk, financial risk from you and transfer it over to an insurance company in exchange for a premium. So they charge you a premium, you hand them the financial risk. And that's kind of what insurance is at its core. And while that's not a sexy thing, believe me when I say, it's not sexy, it's not interesting, it's not investments or asset allocation or, any of those wild things that people want to focus on because, they're going to make them rich. It's not popular, but it's important. And that's the thing. When something traumatic happens in your life, and you have that split second reaction, that moment where you realize that fundamentally everything's changed for you. Nothing will be the same. Having insurance, having the protection that you need, taking care of the people you care about, including if it's just yourself, and knowing that you've done what you could to minimize that impact, the value of that moment cannot be overstated. If you took care of your business, if you took care and you manage your personal finances the right way, you didn't just focus on did you lease or buy a car, you really got to the important stuff, like this. You're gonna love yourself forever for doing that, because whether it's just for yourself or it's for people you care about, if you can minimize that financial burden, if you can know that fundamentally your lifestyle, what you've built for yourself can at least remain the same, is huge. It's enormous. Quite frankly, managing your risks is one of the first things you should do. I mean, we talked about this in another video, but if you have debts, if you're trying to work on your budget or you're planning this, that, or the other, while you're sorting all that stuff out over the course of 6 months, a year, 2 years, or however long that might take, who's to say that something catastrophic doesn't happen in that time? You can't bookmark a car accident. You can't bookmark a heart attack or a cancer diagnosis or, falling off a ladder or whatever. Some of these things they're going to happen when they happen, unfortunately. And so you have to address them before they happen. You can't get into a car accident and then call, an insurance company and get disability insurance or life insurance. It's just not how it works. Actually, that's called adverse selection. But anyways, you can't do that is the point. You can't call the insurance company once your house burned down and say, hey, I need some insurance on my house. It doesn't work like that. You have to do it beforehand. So some of these things you can't wait on. And that's why, realistically speaking, when you're in your financial plan, when you're dealing with your personal finances, managing your risk needs to be right there at the top of the list. Priority number 1, 2, 3, right in there. And we could go back and forth about which of those actually is first, but just know that if you haven't done those things, you need to. Now, where insurance contracts become kind of interesting, at least, in my opinion here, where they can become a little bit interesting is the fact that these are contracts, and contracts you can add riders to. Riders are extra provisions that you can put onto a contract to alter it somehow, enhance it or adjust it, modify it. So you kind of have your core contract here, and then you can make these adjustments by virtue of riders that you can add or remove or whatever you want. You can basically build out, when you take into account in aggregate all the insurance companies that are out there and all the different types of products that they offer and all the different riders that each of them offer, you can really tailor insurance to fit your needs. So it's one of those things that is worth doing some shopping and looking around and really trying to find what fits you best and what you think you need to, what you need to do to manage your risk the most. But I will tell you, as a fundamentalist, when it comes to insurance products, I'm a big believer that you get it for the reason that you needed it in the first place. And in this instance, what we're talking about is managing the risk, the financial risk, that if you were disabled and could no longer work, that you would need some money in the future to maintain your lifestyle somehow. And so what really matters most is getting to that number first, right? How much do I need? Once you've got that number, once you've reached that point where you've got what you need, then you can expand out into doing riders and kind of adding some things on to the bells and the whistles. I don't want to make them sound like they're useless or unnecessary, but they're just not as big a priority in most cases as the actual core reason for getting the product in the first place, which is the benefit, the payout that you're going to get. So when again at the top, again at the top, I mentioned your $1 million asset. So how do we get to that exactly? Well, let's say, for example, that you're 30 years old and you're working and you're making $50,000 a year. Most companies will only let you insure up to about 80% of your income. Okay, so if you're making $50,000 a year, you can do 40,000 that could be insured. And we're going to talk a little bit more about some other parts of that in a bit here, but you can do about up to 80% of your income. They won't let you do 100 for a very good reason. They don't want you to have an incentive to never go back to work. If they're paying you, disability for the rest of your, every single year for 100% of your income, even if you could work really hard to somehow convalesce and get back into the workplace, you might not have the incentive to. And so they really say, hey, look, 80% is as high as we're going to go. And if you want to get back to where you were 100%, you're going to need to really work hard at getting back to work again. So $50,000 a year at 30 years old, you can insure up to $40,000. If you were disabled, knock on wood, let's say you had a stroke or something like that and could never work again. And let's say you built your policy to go to age 65. We're talking about $1.4 million. That's the asset stream between age 30 and age 65 of a $40,000 a year payout from an insurance company. $1.4 million. That's not adjusting for inflation. That's not adjusting for the idea that you might see raises and bonuses and things like that in your future. Realistically speaking, depending on your age, the value of your asset, your ability to earn an income is your largest asset, more so than your house, more so than your 401k, more so than any collection of whatever you have. Your ability to earn money is, in all likelihood, for most people, their largest asset. So you've got to protect that. If your house was, for most people, their house they probably view that as their largest asset. And of course, everyone has homeowners insurance. Why wouldn't you? Your house could burn down. You could just as easily have an accident. In fact, you're 3 times as likely to have an extended disability during your working years as you are to die prematurely. Now, I'm a big believer that, when you're managing risk, probably at the top of the list, you need to look at the biggest ones first. What could be the biggest impact to you and the people you care about? And so for most people, it's really disability insurance, life insurance kind of go head to head. Disability insurance is a really big one, clearly. I mean, $40,000 a year, 35 years, $1.4 million. That's a huge figure. And that's on the low side for most people, probably. Now add to that if you're disabled, the real kind of nightmare scenario here is that you now have additional costs that are coming into play too, because this will sound bad, but if you die, at least you're gone. You're not incurring charges anymore at that point. People beyond really don't continue to rack up credit card bills. But if you're on disability, if you're disabled permanently, you're still incurring costs. You still need to eat. You still need to, go places. There's utility bills and maybe nursing care and any number of things. You could have to retrofit your house for certain things, put a ramp in. This costs keep coming if you're disabled. And so not only are you not able to earn an income, but you're also adding costs, and in some case, extra costs on top of that. So these are really kind of the two top things that need to be addressed. We address the biggest risks first. And this one's a big one, clearly. So when we look at a disability policy and how you can structure it, there are kind of two main factors here. First is how long you want the coverage for, and then how much of your income you're looking to offset. You can build policies that'll cover you for a year, 5 years, 3 years, 7 years, 10 years, or up to a set age. Sometimes, for a lot of cases, it's age 65, for example, until age 65. And that's a really solid time frame. If you're in your 20s or 30s and you say, hey, look, I want this to cover me until I'm 65, you can do that. Bear in mind, the longer you stretch out your policy or this benefit period, and the more you try and insure, the bigger that amount is. So of that 1.4 million we were talking about, if you only tried to cover 5 years instead of until age 65, the amount at risk there, the amount that you're covering or transferring to an insurance company isn't 1.4 million. You're transferring $200,000, $40,000 times 5 years, $200,000. So obviously that's going to decrease the cost of the policy quite a bit. So these are the kinds of things that you can adjust. One other kind of important thing to discuss with disability insurance is that it's also largely based on your profession, what you do for a living. Some professions are much more inclined to injury than others. If you're a welder or a pipe fitter or you're a long-haul truck driver, it's going to be very different from you being an actuary that's sitting in a cubicle all day. Although I do know some pretty wild actuaries. Your profession is extremely important when it comes to how much your disability policy is going to cost you, and more importantly, how they're going to rate you. They're going to look at how healthy you are for sure, but your profession comes into that quite a bit too, in addition to your habits, such as do you do extreme sports? Do you do professional, do you do martial arts all the time in your free time, or sky surf, or who knows what, bungee jump? Those things will come into play in addition to your profession being kind of a key thing here. For most people, if you have an employer that provides insurance for you, they're probably providing some measure of disability insurance for you. And it's important that you take a look at that and kind of figure out what the provisions for that are. Is it a 40% benefit? Is it a 60% benefit? Is it for 5 years, 10 years, or until 65? How is that policy structured? That's going to be important to you, and it's going to be important for another reason here. And that is basically, if your employer pays for the policy, if they're paying for your disability insurance, then if something happens to you and you go on claim, that benefit that you're getting from your employer's policy that they pay for is still taxable to you as income. That might seem obvious. It might strike some of you as weird. People react differently to hearing that. But if you pay for a policy yourself out of your own pocket, the benefit is non-taxable. It's not counted as income. It's like life insurance. If life insurance are generally speaking not taxable, the death benefits from them. So if you die and you pass off the money to somebody, that benefit's going to go to them tax-free for the most part. Asterisk next to that, there's a bunch of qualifications, but in general, it's going to be tax-free. Disability insurance has that same kind of provision where if you pay for the policy yourself, not taxable. If your employer pays for it, it is taxable. And so what ends up happening a lot of times is you'll have some base level of employer coverage that'll be there, and that part will be taxable, whether it's 40, 50, 60% for 5 years till age 65, however it's structured. And then people will get supplemental disability income insurance on top of that they pay for themselves, and that piece would be non-taxable. And so all of this added together should create some offset for you. Now, how long you want your insurance coverage to last for is kind of an interesting question, because some people will want full indemnification. They want to know that, hey, I don't want my family to have to worry about this at all. Or I don't want to have to worry about it. If you're young and 23, obviously you're invincible. Nothing can ever affect you, of course. Just wait. If you're young and, you don't have any financial dependence or anything like that, then this is essentially about taking care of yourself and also making sure that your family, your mom and your dad or your grandma and grandpa, whoever, siblings, friends, don't have to help pick up the burden if something happens to you. So it's about insulating you, but it's also about insulating people around you as well, to make sure that they don't become burden sharers with you, albeit unintentionally. If you have financial dependence, then you might want to look at a longer run here. Let's say that your spouse is a stay-at-home spouse, mom or dad, staying home with the kids. Once upon a time, they worked and they made an okay income. In that situation, if you're already working on, if you're already living on one income, then maybe what you'd need in this circumstance would just be more of a transitionary type policy, which would say, hey, look, I need a 5-year benefit period because I would need 5 years to, for me to transition out of working and just make sure that my family's stable and everything's okay, while my spouse went back into working again and, started earning their income. This, by the way, ladies and gentlemen, is one of the key benefits to having learning to live on one income. It reduces the insurance burden in some aspects as well, just so you know. But you can build it out. Insurance tends to be built as either, indemnification or for transition, those kind of two purposes. So you can try and offset the entire thing for your, until age 65, or you can just try and set it up. Look, this is how long I think it would take us, me or my family, to make an adjustment in our lifestyle, so that we can continue on with our current lifestyle or some other acceptable level of lifestyle that you've decided on. I'm bringing up how to structure these things because disability insurance can come with some sticker shock. I mean, if we talk about this $1.4 million benefit or this $1 million benefit, and then you take into account the increased likelihood that it would happen, that it would, over something like you would die, the premium is going to be higher. You'd probably be hit with a little bit of sticker shock there. And the probability that something would happen to you is right there in the premium. Take $1 million life insurance policy, a term life policy that's, let's say, 30 years, and take a 30-year disability insurance policy for that same $1 million benefit, if you will. The disability policy is going to be far more expensive than the life insurance policy. And it's simply because the odds that something will happen to you is that much higher, which in a lot of ways makes this all the more important. So while a lot of people spend time stressing in personal finance about these things that are, how much to spend on a car and how much should I spend on my house? What's the best method for budgeting? I'm not saying that stuff's not important. It is a lot like a lot of other things in personal finance. But these things are crucial. Getting this stuff done, it might not be popular, but it is important. Worst case scenario when it comes to how much you get, when you get that sticker shock moment where, holy cow, this costs how much to do this? That totally unexpected. It's a car payment type cost to do this. Keep in mind that some is better than none. People have this tendency, and actually this happens a lot in the long-term care side as well. When people see the cost of long-term care and offsetting that, they say, wow, that's way too much. It's because you're trying to offset the entire thing. Get the benefit you need for as long as you can. Probably start there, whether it's 5 years, 10 years, whatever. I would aim more at hitting that benefit period for as long as possible than necessarily going until 65. But that's a little bit of a toss-up and kind of a personal choice, personal preference of how you feel. But just keep in mind that some is better than none. And your employer policy is probably pretty good. If it covers 60% and it's, just keep in mind though that it's going to be taxable. Make sure to investigate to see if your employer offers it. If you can do an add-on to buy additional coverage through them, it'll probably be a lot cheaper, although it's not necessarily portable. Meaning if you leave your employer and go somewhere else, you probably can't take the policy with you. For sure, not at the same premium level. So, there's some benefits to buying your own out there anyways. But make sure you do some shopping around because disability insurance is also one of those things that, different companies tend to take, kind of pick their spots on. Some companies really want people and some companies really don't want some people. And so it's usually based on their profession and age and lifestyle. So all that comes into play. but some is better than none. That's kind of the key thing here. If you can't do it all, don't worry about it. If you can only get halfway there, that's better than nothing, right? So take that kind of approach and see how much you can cover. Okay, that's all I have for this segment. There's gonna be more of these sexy topic ones on insurance. But in the meantime, if you have any questions, please don't hesitate to let me know. Just drop them in the comments down below. Click subscribe to join the Plan Ranger community. We'd love to have you. And until next time, thanks for taking the time. We hope this helped.